Welcome to Second Take, the show that focuses on the issues behind the news. State-owned enterprise Transnet has directed about 100 billion rand of its capital investment program towards the upgrade and expansion of South Africa's key commodity export corridors. Mining Weekly editor Martin Creamer tells us more. Welcome, Martin.
Thanks, Shannon.
Now, some 50 billion rand has been set aside in Transnet's capital investment budget for South Africa's coal corridor. Can you tell us more about these plans, particularly for the Richards Bay coal terminal?
Yes, there's been a lot of big numbers bandied about in South Africa, and the state president has been talking about 840 billion rand on infrastructure. And of course, we've come to look at that with a little bit of skepticism sometimes, because the state mentions big figures, but they don't get to spend it. It's a different story with Transnet. They've got a credibility. When they announce they're going to spend something, they generally spend all of it or most of it. So what is happening now is there had been a howl of protest about the lack of logistics around coal export. And so the state had decided, and Transnet had decided, that they were going to spend something like 300 billion rand over the next 7 years. But if you take a third of that now, it's going to go towards commodities. It's going to go towards the mining sector. It's going to go towards giving, movement to the metals and minerals that we produce and getting them to the ports and getting them to their destinations. And we see half of that is going to go towards coal. So they're putting quite a big store on coal. We've always had this mismatch, because you have the state owning the railway line, which is the coal line to Richards Bay, but then you have the private sector companies owning and operating the Richards Bay coal terminal. And never the twain have met. We now have a situation where the capacity at the terminal, which is private sector led, is far greater, 92 million tonnes. What has been delivered by Transnet has been 68 million tonnes. So it's far short, and the economy of South Africa suffers. So the new leadership at Transnet has picked this up, and Brian Molefe is a different kettle of fish. He's very focused. And so he's saying to us now that he's going to put 50 billion, into this coal network. And it's not only going to be from our traditional Mpumalanga to Richards Bay. The first part of it will be to create a general freight line through Swaziland to take a lot of the pressure off the coal line, but also to create a link to the Waterberg. Now, the Waterberg is far more inland, and it hasn't had a rail link. It's been stranded. That coal has been stranded. And obviously you think, well, you'd like to get that to the global market. But there's another factor in South Africa. The coal in the traditional Witbank area in Mpumalanga, it's depleting. But the power stations will outlive the coal. So what are you going to do when you've got a power station that needs coal? Where's it going to get it from? That's why that rail link to the Waterberg is so important as well. So they can bring that coal from the Waterberg for domestic use and also for export. So it's going to be quite a good fillip for South Africa. And we just hope that the market is still strong at that stage, because we tend to miss markets sometimes. And the whole mining industry is cyclical. That demand is so important. Hopefully there'll still be strong demand when all the capacity is set in position.
Now, a further 25.9 billion rand will be invested in the so-called South Corridor. Can you tell us about this corridor, as well as which commodity it will focus on?
Yeah, the South Corridor, the part that Mining Weekly Online looks at, and Mining Weekly looks at, is the part that says we're going to send manganese from the Northern Cape along the traditional route to the port of Coega, the Coega port in just near Port Elizabeth. And what they're going to have to do, they've committed themselves with this expenditure to reinforcing that and making it a heavy ore line. The jury's still out on that. They say it's the cheaper route. The industry is, beckoning them to use the iron ore line rather, also for manganese. They've decided, no, definitely they're going to go to Coega and they're going to turn the general freight line into a heavy ore line. I think that will be good, and maybe they can actually have two routes eventually. I don't know. Some people seem to feel that, but I think Transnet is only thinking one way, and that is the Kalahari manganese fields, linking that with the Coega area and exporting manganese from that port. Of course, we've exported manganese for decades from Port Elizabeth. That will move to Guga in time. And then the whole South Corridor is more than that. It's also linking inland resources in the country to the ports of East London and also Port Elizabeth. There are also opportunities there. So they're getting a lot of ports set up now to make sure that we can create wealth in the country from the metals and minerals in the ground. And also they want to do more with the metals and minerals on the beneficiation front. So you've got this twin possibility of exports and domestic value added.
Now, finally, Transnet's market demand strategy includes a plan to raise domestic iron ore volumes by 134%.
You know, of all the lines, I think the Sishen to Saldanha iron ore line has probably been the slickest. And, you know, it has been running at about 53 million tonnes, which has satisfied the iron ore miners. But I think we've been singularly unambitious, because when you look at what is exported out of Brazil and Australia, I mean, we're way behind. And although they say we're going to be the fourth biggest in the world, etc., you know, we could have done far better at the right time. So we Johnny come lately is there again when it comes to increasing that capacity. You know, even under the previous government, they were talking about taking it to 100 million tonnes. They're still running on 53 million tonnes. So there is going to be a big leap towards the 98 or 93 million tonne mark, and that is a very good thing to do, because there's still a lot of iron ore bulls out there in the world, and they realize that you can't do anything in the world without steel. So you need that iron ore, and that line, I think with a few extra loops and some expansion there, could bring in that extra capacity, which would be very good for South Africa as a whole. And I think that the Western Cape is also looking to benefit from that and do far more in the Saldanha Bay, maybe some beneficiation as well nearby from other metals and minerals, but it's seeing that as an industrial development zone. So a lot of things happening at one time in South Africa. We know that it's very late. I mean, this should have happened ages ago. You know, we were talking about the expansion along these lines in the mid-90s, and we're now going towards 2012. When will we have this? Presumably in the 7 years that they're talking about, hopefully.
Well, we'll just look out for it and hope for the best.
We shall do. Keep a good eye on that.
Definitely. Thank you very much, Martin.
It's a great pleasure, Shannon.
That's the show for today. Join us again next time for more news and insight into what's happening in the mining world.